We are covering these 8 top actively traded stocks that are bullish today. While watching price actions, let us inform you. Our review on GOGL, Golden Ocean Group Limited, a major player in the dry bulk shipping industry, just made some key leadership moves. The company, which operates a fleet of 83 dry bulk vessels transporting commodities like ores, coal, grains, and fertilizers worldwide, announced the appointment of Karl-Erik Steen and James Ayers as new directors. Steen has a solid background in shipping and banking, with previous roles at Nordea Bank and Christiania Bank, while Ayers has been with Golden Ocean since 2018 and has extensive experience in maritime and offshore energy. The stock ticked up 2.7%, and while director appointments don't always drive immediate price movements, they do signal strategic positioning for the future. Investors often look at board changes as a sign of where a company is headed, whether it's focusing on expansion, restructuring, or strengthening financial management. In Golden Ocean's case, these appointments align with its efforts to navigate the constantly shifting global shipping landscape, especially with ongoing market speculation about SIMB, tech's interest in a takeover. For investors, the big question is how these changes play into Golden Ocean's long-term strategy. The dry bulk market is known for cyclicality, and having experienced leaders at the helm could help the company capitalize on charter rate fluctuations, new building opportunities, and potential M&A activity. Definitely worth watching how this unfolds. Our review on BRZE, Braze Incorporated, the customer engagement powerhouse, just wrapped up a strong quarter, and investors are taking notice. The company, which helps brands deliver real-time, AI-driven customer interactions across multiple channels, delivered a solid earnings beat and some big strategic moves. Stocks up 2.7%, and here's why. First, revenue hit $160.4 million, up 22% year over year, fueled by strong subscription growth. Even better, Braze turned a corner on profitability, posting $8 million in non-GAAP operating income, a major shift from last year's losses. Big customers are also doubling down. Those spending $500,000 plus annually jumped 22% to 247, showing strong enterprise demand. One of the biggest headlines? The $325 million OfferFit acquisition, which is expected to supercharge Braze's AI-driven capabilities. This move could make the platform even stickier for customers looking to automate and personalize engagement at scale. Of course, not everything's smooth sailing. Macroeconomic uncertainty is dragging out enterprise sales cycles, and Meta's decision to drop WhatsApp marketing in the US adds some friction. But Braze is brushing it off, noting that most demand for WhatsApp messaging comes from international markets anyway. Looking ahead, Braze expects revenue to grow another 16% in fiscal 2026, with OfferFit adding another 2% bump. With analysts like JP Morgan backing the stock, citing its retail focus and AI innovation, Braze is positioning itself as a long-term winner in the customer engagement space. If they keep executing like this, expect more tailwinds ahead. Our review on ACI, Albertsons Companies Incorporated, one of the largest food and drug retailers in the U.S., just saw its stock rise 2.13%, and there's some buzz building around what's driving the move. With over 2,200 stores under banners like Safeway, Vons, and Jewel-Osco, plus a strong digital presence, Albertsons has been holding its ground in an increasingly competitive grocery landscape. So, what's behind this latest uptick? It could be a mix of optimism around consumer spending, shifting grocery inflation trends, and ongoing speculation about its proposed merger with Kroger. That deal, which has been under heavy regulatory scrutiny, could shake up the grocery industry in a big way, but hurdles remain. Still, some investors might be betting that progress, either on approvals or alternative strategic moves, could be in the works. Beyond the merger drama, Albertsons has been making steady moves to boost profitability and keep customers engaged. The company has been leaning into its private label brands, expanding digital and loyalty programs, and improving operational efficiencies to navigate high costs. Grocery chains have been facing pressure from both rising expenses and changing consumer habits. But Albertsons has been adapting well, keeping foot traffic steady and strengthening its online presence. With demand for essentials staying resilient and Albertsons fine-tuning its strategy, investors are watching to see if this momentum continues. If they can push through economic headwinds, drive higher margin sales, and make progress on strategic initiatives, there could be more room for growth ahead. Our review on AngloGold Ashanti PLC, a major player in global gold mining, just dropped its 2024 annual and sustainability reports, and investors are taking notice. With the stock up 2.21% today, this kind of move suggests the market likes what it sees, so let's break it down. The reports cover operational performance, sustainability efforts, and resource management, all of which are key in an industry that's not just about mining gold, but also about how efficiently and responsibly it's done. Investors are always looking for clues in these reports. Are production numbers solid? Is the company keeping costs in check? What's the outlook on reserves? These details help shape expectations for the stock moving forward. Sustainability is also a big deal in mining. With increasing pressure from regulators and investors, companies like AngloGold need to show they're managing environmental and social risks while maintaining profitability. If their report reflects strong ESG, environmental, social, and governance initiatives without compromising margins, that's a win-win scenario for long-term growth. And let's not forget the timing here. Gold prices have been holding strong, partly due to economic uncertainties and central bank policies. Higher gold prices tend to boost mining stocks, and if AngloGold is efficiently running its operations, it could be in a prime position to capitalize on that trend. With their 2025 AGM set for May 27th, there's a good chance we'll get more insights into the company's strategy and outlook soon. For now, today's stock move suggests investors are giving a thumbs up to the company's latest update. Our review on WELL. Welltower Inc, a major player in healthcare real estate, just made a big move, filing for a $7.5 billion mixed securities shelf offering. And investors seem to like it, with the stock up 2.33% today. So what's going on here? A shelf offering like this doesn't mean an immediate stock sale, but it gives Welltower the flexibility to issue new shares, debt, or other securities over time. That kind of financial firepower can be a strategic tool, especially for a company in expansion mode. Given Welltower's focus on senior housing and healthcare real estate, this could mean acquisitions, new developments, or refinancing existing debt, all things that could drive future growth. Why is the market reacting positively? Investors might be betting that Welltower has strong opportunities ahead and that this capital raise will be put to productive use. The senior housing sector has been heating up as aging demographics drive demand, and Welltower has been positioning itself to capitalize on the long-term need for healthcare infrastructure. That said, issuing more shares could lead to some dilution for existing shareholders. So the key question is how Welltower plans to deploy this cash. If the company can translate this into high-yielding investments, the stock could have even more room to run. For now, the market seems to be giving Welltower a vote of confidence. Investors will be watching closely for details on how this capital gets put to work. Our review on KMI Inc, one of the biggest names in energy infrastructure, is getting a fresh wave of optimism, thanks to rising natural gas prices and surging LNG demand. Goldman Sachs just reiterated a buy rating with a $31 price target, signaling confidence that Kinder Morgan is in a strong position to benefit from market trends. The stock is up 0.5% today, reflecting a cautiously positive reaction. So, what's driving the momentum? The natural gas market is heating up, and Kinder Morgan's vast pipeline network, especially its heavy presence in Texas, Louisiana, and the southern U.S., makes it a key player in the booming LNG export industry. Demand for LNG is expected to grow significantly through 2030, with exports leading the charge. That's a big tailwind for KMI, which already controls about 45 to 50% of U.S. LNG and power plant connections. Financially, Q1 looks solid. Analysts expect EBITDA of $2.18 billion, slightly ahead of both consensus estimates and company guidance. Higher gas prices are helping, and the recent Outrigger acquisition is adding to the bottom line. While only 5% of Kinder Morgan's business is directly tied to commodity prices, better pricing could still provide a $50 million boost, partially offset by weaker biofuel credit pricing. Looking ahead, Kinder Morgan seems to be shifting gears. After rolling out billion-dollar projects in 2024, the company is now expected to focus on smaller, more targeted developments, ranging from hundreds of millions to $500 million. That said, big expansions, like increasing capacity at Trident, are still on the table, with updates expected later this year. Bottom line, Kinder Morgan is in a good spot. The macro environment is finally working in its favor, and with LNG demand on the rise, the company is well positioned to capitalize on long-term growth. Investors will be watching closely to see if the company can turn this momentum into sustained earnings strength in the coming quarters. Our review on KHC, Kraft Heinz Company, the global food giant behind brands like Heinz, Kraft, Oscar Mayer, and Philadelphia, is seeing some renewed optimism from investors. The stock is up 0.57% today, and a recent rating upgrade is shifting the conversation from concerns about stagnation to a legitimate high-dividend opportunity. For a while, Kraft Heinz had a bit of a reputation as a value trap, one of those stocks that looks cheap but never really delivers much upside. But now, analysts are starting to see the long-term potential, especially with the company's steady cash flow and strong dividend yield. If you're an income-focused investor, this might be a name worth watching. The big selling point here? Reliable dividends. With consumer staples, people keep buying ketchup, mac and cheese, and deli meats no matter what the economy is doing. That makes Kraft Heinz a defensive play with consistent revenue streams, even in uncertain markets. That said, it's not all smooth sailing. The company is still navigating inflationary pressures, changing consumer habits and competition from private labels. But the key takeaway is that Kraft Heinz isn't just a struggling packaged food company anymore. It's evolving into a more stable dividend play with the potential for long-term gains. Investors will be keeping an eye on whether this momentum can build, but for now, the stock is getting some well-earned attention. Our review on AQN, Algonquin Power and Utilities Corporation, the Canadian energy and utility player, is making moves as it continues restructuring its business to focus on core regulated utilities. For investors, this is a stock that's been in transition, once known for its renewables, now shifting gears to a leaner, more predictable business model. Over the past year, Algonquin has been shedding assets, selling off its renewable energy division to reduce debt and streamline operations. The goal? A more stable, lower-risk utility business that delivers consistent returns without the volatility of the renewables market. Investors have been waiting to see if this plan would pay off, and so far, it looks like sentiment is improving. With over 1 million customer connections across North America and beyond, Algonquin is positioning itself as a steady dividend payer in the utility space. The big question now is growth. Can the company expand its regulated utility footprint while maintaining financial discipline? For now, the restructuring seems to be boosting confidence, but investors will be watching closely to see if Algonquin can keep execution on track and turn its leaner, more focused strategy into real long-term gains. Please subscribe, give the video a like, and watch more from our playlist. Thanks.